Good morning. I am here with Steve Gaito of Retirement Resource. And this is a feature that we do. It's called Now You Know, and it is part of our digital advertising package. And we want to welcome Steve this morning. Good morning.
Good morning. How you doing, Tina?
I am doing well. Thank you so much for coming on, taking the time out of your busy schedule. I know you've been traveling a lot, doing a lot of good stuff for people. So we're going to jump right into it. And I sent you some questions earlier just to kind of quickly review, get your head wrapped around what we're going to talk about today. But we want to talk about, you as an individual, as a business, you are your business. It's not like you're a corporation. It's not like you do some things a little bit differently. And I want to talk about that. You approach retirement planning a little bit differently. We're going to address that in the questions that we're going to have today. But first of all, tell me a little bit about how you got into this line of work. What drew you to this? Were you always a financial person, or?
No, actually, I started out, my degree from college was in outdoor recreation management. And I was working for Camp Seagull down on the coast, which was the largest YMCA camp in the world.
Nice.
And we were expecting our first child. And Meg and my wife was working for Meredith College, and we realized that it was going to be extremely difficult to raise a family on two nonprofit salaries back in the early 90s. And so I was having a conversation with a friend of mine. We were actually talking about 403B plans, which is a nonprofit version of 401k plans. And he was surprised I even knew what it was. And he said, well, would you ever consider coming and working with me and help set up pension plans for nonprofit companies, organizations? And I said, well, that might be interesting. And I said, what does it mean? He said, well, it means you have no guaranteed income. You're going to work your tail off, and it'll take you about 2 years to make a living. He said, but after it, you'll love it. And I said, sounds like a fair deal.
You already had that nonprofit mindset of giving back.
I did. I love the service part of it. I love going around the state and sitting down with HR departments and figuring out how to set up the right plan for their particular people and how to encourage them and educate them. And so it tied in a lot of the things that I like doing. I've always liked finances. I mean, my minor was marketing in college, but I was the numbers guy at the Y. I wasn't the fun guy. I was the numbers guy. And so you got to have some of those. And it just was the right time. And so I worked for Valak for about 9.5 years, had a great time. And then they were sold to another company, and the corporate culture wasn't the same. So I went back. I was actually offered a job back at the Y to be the senior vice president in charge of camping. And so I did that for 3 years and loved that time, loved working with the Y, but I missed the financial planning. And during that course, two things had happened. One, I had taken my Series 65 license to become a registered investment advisor. The second was I finished my CFP, which is by far and away the hardest course I've ever taken. I mean, it involved so many things, 5 years, and it was terrible.
Tell us what CFP stands for, and what is the importance of that designation? So for people that don't know.
Yeah, CFP is a certified financial planner. It's the top designation in the financial planning world. And it requires you to be a fiduciary, which you hear a lot of things people talk about being a fiduciary. CFP has accountability with it. I mean, you lose your designation if you are not acting as in the client's best interest. And for those that aren't familiar with the term fiduciary, that simply means that I have to put your interest ahead of mine, ahead of the company's, ahead of everybody else's, which was easy for me to do because that's consistent with how I've lived my life, is I always put others ahead. And certified financial planner encompasses more than just how to handle investments. It is taxes, it's estate, it's healthcare, it's long-term care. It's a lot of different components all wrapped into one designation. When I took it, there were 5 modules. They've added a 6th module now for the folks that are doing it. The pass rate was like 35%.
Wow.
And so I took the 2-day exam after spending 5 years studying. And I hit the submit button on there and thought, I failed this thing.
You're like, okay.
And lo and behold, I got the little certificate saying I passed it. I want to know what score. And they said, you shouldn't care just as long as you passed it. And I said, okay, words well taken. And so I've done several things. I managed money till about 2008, and then realized that that was too much stress. It wasn't what I liked doing. I like the puzzle part of financial planning. And then I took, after basically doing hourly financial planning for a few years, I switched over. I worked for a company, Social Security Solutions, that did Social Security education and training for advisors throughout the whole United States. I spoke on national stages for Financial Planning Association conferences with Social Security to help people understand how to get the most out of it. Ironically, only 2% of people get the maximum benefit out of Social Security. That to me blows my mind. You know, if as a financial advisor, if I only gave you the 98% was the worst case advice, that would be a bad advice. And so people don't understand it. I like to help them do that. And it's also the easiest thing to control in retirement planning. And from there, I moved to Marion about almost 2.5 years ago. And I worked throughout North and South Carolina. I traveled down to Hilton Head. I traveled to Raleigh. I go to Charlotte. I go to Greenville, South Carolina. I do a lot of educational events and help people understand some different ways of doing retirement planning.
I love that education is a big part of what you do. That's the nonprofit kind of service giving back element of what you do. And what you use the term puzzle. And I think a lot of people, myself included, for a while, it was like financial. I'm a words person. So finances were, you can do the basic things. I can balance my checkbook. I can do a savings account. But my knowledge at that point, it's limited. So when you're talking about retirement and you're talking about planning for the future, or even making the most of the money that you have, you don't necessarily have to make a lot of money to save and earn and make investments and things like that. I think that's a misnomer that I've learned over the years. So the fact that it's a puzzle piece and you have this expertise in all those different pieces, like you've got that education in Social Security, you've got, education in 401ks and things of that nature, and even investments. So bringing all that together paints this broader picture for the client that, maybe they just don't have the expertise, or they've got this. I know a lot of people that have this fear of financial, knowledge, and they think that it's too much for them. So how do you dispel that? How do you make your clients feel comfortable? Do you run into that a lot where people are just saying, hey, I just want to save some money, or I just, how do you approach that?
Yeah, and that's a question that comes up. There was actually a quote. It was in church this past Sunday. I wrote it down. It was so cool. It said, the right answer to the wrong question is still the wrong answer.
Love it. Mm-hmm.
And I run into that the most is that people don't know what they don't know. I've got a client that lives down in Hilton Head, and she came to one of my seminars and was listening to it. And she said, oh, I've got to have long-term care. I realize now I really, really need long-term care. And I said, okay. And the average person would have just filled out the application, sold her the long-term care plan, and been done with it. Mm-hmm. The planner in me says, let's look at the whole big picture and make sure this is appropriate. And that's what I find quite often, is that it's not that they've been given bad advice, they've been given incomplete advice. Mm-hmm. Mm-hmm. And so what I find is most advisors know what they know, but they don't know what they don't know. Yeah. And being the only certified financial planner in McDowell County, I think my knowledge is a lot broader than most. So back to the client down there, we sat down and I said, let me get your budget, let me get your assets. And we worked out, came up with a baseline, and she was going to run out of money at age 88. If we put the long-term care plan in there, she was going to run out of money at 84. Mm. Well, I looked at a couple other strategies and was able to reallocate her resources, and her money's now lasting to 97. So that's another 9 years of money lasting. And then even at 97, when she ran out of money in liquidity, she still had more income than just Social Security. And so that's what I think most people don't realize is, the name of the game is not assets. The name of retirement planning is income. And you have to create income strategies that do a couple of things. One, protect you when the market goes down. Two, protect you when you get older. And three, protect you when you have a long-term care event. And so any of those three things can significantly change the way that you approach retirement.
Yeah, and having someone walk you through that and really take each client individually and care enough about them and their situation, because there's no one answer for every person. There's basic advice, but the fact that you take that time with each client to learn their situation, to look at all their assets, to look at all the possibilities, and really frame something that's going to protect them and help them and feel confident. Having that confidence of knowing makes living life a lot better, doesn't it?
It does. And that's why I don't understand people that are stressed out about just having a portfolio in retirement. When they started saving for retirement, what was the purpose in saving that money? It wasn't to create this large portfolio. That's the biggest fallacy that's out there, is that you've got a special number of assets that's going to make you feel comfortable. Mm-hmm. Well, in 2008, when the market drops 40%, I don't care how much assets you have, you're not going to feel comfortable. Mm-hmm. However, if you've set up income that you can't outlive and aren't impacted by the market, it's just another day in the market.
Absolutely.
And so, the reality is, if you want to have comfort and you want to have certainty, you've got to create some of those things. Now, having said that, I see people that do the total opposite end of this, and they put everything into those annuities or into those other policies that are going to give them income for life. It's not a one size fits all. A good friend of mine says, when all you have is a hammer, everything looks like a nail. And so they're constantly that one product is all they know, and that's all they do. And so I like to create different buckets for different times. Right now, we're in a unique situation with the tax laws we have. When you look at the Trump tax laws that sunset in 2026, I know that everybody is going to have a tax increase. What it tells you is a 5-year period that you can get things in the right place at the right time to pay less taxes. And so the illustration I often use in my seminars is, who goes shopping the day after Thanksgiving? Whether you go online or you go to the mall, whatever you're doing, a lot of people do it. Not because they need that stuff so bad the day after Thanksgiving, it's because it's on sale. Mm-hmm. And they're going to get more value for their money to use later on when they give it as a gift at Christmas.
So same thing's
true.
You're saying that these, with the sunset, as you described it, with that coming into 26, that they have a window of Black Friday or shopping, right?
Exactly.
To really kind of tweak their retirement plan or outlook, or what they've gotten invested in, to really save some money and prepare for that tax increase that's going to happen.
And that's what allowed the client that was down in Hilton Head, because it was much more tax efficient how we took her withdrawals over the next 5 years. And when she created tax-free income later on in life, it allowed her money to last longer.
That makes a lot of sense. Yeah.
And I can show that. I mean, that's the reality is, I'm not just sitting here saying, oh, I've got this magic potion that does it. I spent a ton of money on software to be able to illustrate this and show what it does. And so I start with a baseline. Here's where you are. If you do nothing, here's what happens. Let's look at what a long-term care does to this. Let's look at what, the taxes that increase in 5 years do to this. Let's look at the tax increases happen to a couple when the first spouse passes away. Most people don't think about that. I know it because my mom's dealt with it. All of a sudden, she's in a higher tax bracket going, what in the world happened? Well, your spouse passed away and now you're filing single. You got to plan for those things.
And most people don't realize that how that is going to affect them, and therefore that they don't plan. Like you said, they don't 100%. Know what they don't know. I'm going to jump into the second question. What are the core principles that guide your practice?
Yeah. So I often hesitate to put out Christian faith as one of them, because then when you mess up, and I'm human like everybody else, then everybody thinks that all Christians are bad. But they are sound biblical principles that I apply to everything. I always go from the fact that if I can't prove it on paper, then it's not worth doing. And I actually run into clients that, I'll sit down to evaluate their situation and they're doing a great job. And there's nothing that has to be done. So I'm like, okay, keep doing what you're doing. And to me, that's like going in for a physical and your doctor saying, everything's okay with you. You don't have to do anything.
Yeah.
You have to be happy about it. And so, I use that. I also take a long-term, I am a macro view, not a micro view. And the way to explain that is your CPA is probably a micro view. They're looking to save you the least or the most amount in taxes in any one current year. Mm-hmm. I look at it from a macro, let's save you the most amount of money over your lifetime and save more money when you pass it on to the next generation. I am always looking for what the client wants to do, not what I want to do. And so the client is always going to come first. I believe in proving myself before they pay any money. So I will do all the planning before the first dime is committed to paying me for my stuff.
I think the approach is important because a lot of times you're looking at, you're not allowing markets and things like that to define how you approach a client. Whereas you might go into someone and say, how do you want to invest? Do you want to be a mild investor? Mild probably isn't the right word, but you understand. A strong investor, conservative, and that all is being dictated by a market, not necessarily by what your needs are now and into the future. And your approach is I don't know in the industry if it's unique. It seems to be somewhat unique in the sense that you're really approaching it from a different perspective altogether.
Yeah, and so the easy way to explain that is that most are focused on the accumulation of assets. Mm-hmm. That's the saving one. And that is what they continue to use in retirement, which is very dangerous. Because when you're saving in for retirement, you're able to take advantage of things like dollar cost averaging. So when the market goes down, you buy a lot more shares and it all works out in the end. When you're on the distribution side, you can't afford that. And that's easily illustrated by looking at sequence of returns. And so if you look from 2000 to 2015, and you take the sequential one, you have $100,000 and you're taking $5,000 out each year, you're going to have about $40,000 left after 15 years. That's just because of the way the market, responded. On the other hand, if you reverse it, you go from 15 back to 2000, just a complete inverse of that. Same situation, you have $112,000 left. So what did the person do different? Absolutely nothing. It's just luck. And I believe personally that you don't want to rely on luck in retirement. And if it were easy to do, there'd be a financial fund out there that could do it. But they're just knowing how inconsistent they are on a year by year basis, that changes. And that's why I use different products. I use insurance. I use indexed products that don't have any downside. Why would I use something like that? Well, if you look at the statistics over the last 20 years, the S&P 500 averaged about 6.6%. An index universal life policy with an 11% cap averaged 6.3. What's the difference? Well, the standard deviation of the S&P 500 is 16. The standard deviation of the index product is 4. So for those that are trying to figure out and they're going back to that statistics class and having a stroke, that means that it's 4 times less volatile. And volatility in retirement is a killer. And so I'm always looking at taking those things out.
Give that scenario to us in a real world example.
Well, so you start out, you think of volatility. If you start out with from 2000, it lost money for the first 3 years. Whereas the other one, the index stayed level. You didn't lose any money. And then you had some upticks, and then all of a sudden you had a big downturn. And so I guess probably the easy way to explain it, if you go to Disney World and you ride the big roller coaster that loops around and goes every which way, it does all that stuff. When you get off at the same spot you got on. Okay. And then you go over to the little mouse house roller coaster, the cheese one that just barely goes up, barely goes down, barely goes up, barely goes down. You come back around, you get off at the same spot. Now, one was a lot more exciting. The other one was more stable, but they both accomplished the same thing. The problem is when you're taking money out of investments, when it goes down, you have to take out a lot more. So if I'm taking 10% out of $1 million, okay, then that's $100,000. Okay. If the market drops 40%, I'm at 60,000. That means I'm only getting $6,000 or $60,000. That's significant. And that's why you want stability of income in retirement, because nobody wants to cut their standard of living in retirement. They want it comfortable. And once I explain to people that, we're getting you more money for less risk, and oh yeah, we're also helping you protect yourself against long-term care. It's like, oh, why haven't I done this? Well, nobody ever explained it to them. That's the problem.
Yeah, that's important. All right, into question 3, how are you different from other retirement planners? I think we kind of have touched on that already. Is there something specific that you feel, for example, that you make a conscientious effort with every single one of your clients to differentiate yourself from that? What?
Yeah, there's one. I focus on income, and most advisors focus on assets. Okay. And to explain that a little bit more is I'm going to take what you have and figure out how we can get you the most income for the least amount of risk. The typical advisor that's out there is going to look at how can I grow your portfolio. I don't care what the portfolio is going to grow to. Because
I think that a lot of people go in thinking that that's what they're supposed to do. They're going in, it's like, okay, I've got this money and I want to grow my money because then I'm going to use it for retirement. There's that, I think, that accepted understanding out there in society or the world that that's what they're supposed to do. Yeah. When in reality, you're showing them that there is a different way. And it's less risky, and it's something that people should consider. Like you said, some people that might work great that might be suited for their particular situation. And then others, like you said, that income, planning for the income instead of just that savings that's going to be possibly volatile.
Well, think about it this way. Throughout your life, you've probably received a paycheck every week, month, quarter, whatever it is. Yeah. And you're used to that. You're able to budget for it. You're able to go on vacations. You're able to save. Okay. And now all of a sudden you're going into retirement and it says, we've got this lump sum of money. Do what you can with it. You've never been trained how to manage it. You've never been trained how to, draw down off of it. You have no clue of how it actually works. And that's why people are frustrated in retirement. There's a great story that I tell about the 2 golfers being out on the golf course, and all of a sudden the phone rings and the one looks at his phone and says, oh no, the market's down 40%. He can't concentrate on golf to save his life. He's hitting his shot and running back to the golf bag to check the phone, talk to the broker. The other guy is just having the game of his life. And they get to the clubhouse and the guy says, I don't understand it. We both got the same text. He said, why is it that you're so calm? He goes, well, because my paycheck comes every month to my bank automatically. I don't have to worry about it. Well, when you're dependent on the market, you're dependent on something back to that standard deviation that's going to be all over the place. And that isn't what most people wanted in retirement. When they start saving money for retirement, they just want income so they can do what they want. And most people focus on building a portfolio instead of building the income. I just think that's wrong.
So I'm thinking back on like when my grandfather worked for a company for so many years. There were you know, you had pension plans, you had retirement from your company, you had that built-in kind of security. That is no longer the case. I mean, companies don't employ people for those long periods of times where they build up that retirement with one company. So we are actually, you know, needing to shift the way we do invest and look at retirement in such a different way, because the job market itself and the way people work is so much different. Do you feel that has had an impact on things?
Yeah, and you can look at how 401k plans are changing. They are now looking at adding annuities into their 401k plans.
So tell us the significance of that.
Well, it tells them that most of your 401k plans are designed for growth. I know that because I've sat in front of the CEOs and the boards that are there, and they say, oh, we want the best 10, 20 funds that are available out there. Well, that's looking back. There's no guarantee they're going to do that forward, but you know, you check the boxes and that's what they want. There's never any investments that are in there that are designed for income. And if they are, they're the wrong type of ones. You look at bonds right now, or even fixed accounts that are in these portfolios. When I started in 1993, a fixed account in a retirement plan paid 12 to 14% interest. Now, if I could go back to those days, retirement planning be easy, because on $1 million, that's $140,000 a year. Now they're paying $2 million. That means you get $20,000. That's a big difference between 140 and 20,000. That's the problem with the retirement plans, is that the investments that used to be in them that would provide you with great income are no longer there. And so they're saying, well, we'll negotiate a deal with an insurance company X, Y, or Z to have an annuity option in there, which means you can convert it. It just isn't, you know, it's going to be one that's in the company's best interest, not necessarily in your best interest.
And it sounds like it's more of a low-hanging fruit, and it's like, this is the easiest way we can kind of avert that drop in interest, right? Yeah.
Well, they're also realizing that people want lifetime income, and so they're working towards that.
Yeah. So on to question number 4. What is one piece of advice you would give, particularly in today's market? And looking into the future, let's say, you know, the next 4 to 8 years, 10 years.
Yep. The thing that I always try to tell people to do is control what you can control. And so it starts with Social Security. Get the most you can out of Social Security. It's create an income stream that you can't outlive to cover your fixed expenses. That's the same thing that a pension does. The third thing is look at the money that you don't think you're going to need. And there's a substantial number of folks that are going to have money that they're probably not going to need, and defer it in a tax efficient way, so that if you need the money later on, it comes back to you income tax free. Pay your taxes now, be done with it, kick the government out of your planning business, and draw down your qualified assets first, which is very different from what has been said in the past. But if they will actually sit down and do the numbers, they will see that taking your qualified money right now out of your plans makes a lot of sense, because you're paying the lowest taxes. You know, when 401k plans were set up, the goal was that you would put money in at a high tax bracket to take it out at a low tax bracket. We're at a low tax bracket right now, and they look like they're going to go back up. So what does a retiree want to do? They want to control what they can do, pay the taxes now, and not have to pay the higher taxes later.
So let me ask you, they're gonna take that money out now that the taxes are low. You know, what are they going to do with those assets, with that money?
Well, and that's where the planning comes in. A lot of times we will take some of that money and use it to buy long-term care. Sometimes if they need money in 10, 15 years, we'll put it in something that is tax-free. We may do a Roth conversion. We may use index universal life, depending upon the needs of the client, depending upon their health.
So you're looking at a redistribution of that.
Yeah, we're just basically
efficient. Yeah,
paying the taxes now while they're low.
Yeah.
It's shopping the day after Christmas.
Yeah, that sounds great. Love it. All right. So question number 5, tell us about a favorite client story that made you grateful for what you do.
There's a lot, but it's probably Bill Clifford. Bill is a dear friend of mine. He was one of my first clients at NC State. His wife has, she still works for NC State, can't get her to retire. But Bill will call me. He is an analytical guy, and will call me with questions about everything under the sun. But it's really not about the investments. It's really not about the planning. It's about the relationship. I love it when I go to Raleigh and we go out and have breakfast. We talk about the kids, the grandkids, you know, a little bit about politics every now and then, how we could solve the world if, you know, people just listen to us. But that really is what I see as the best client. It's not about, you know, how much money I can save them or how much, you know, taxes I save them. It's about how do we talk about life and how do I help them, guide them through life. And at the end of the day,
go ahead.
That's what I love to do. Is I want relationships, not clients. You know, I don't have to have a ton of clients to be successful. I want to have a ton of relationships where if they've got a question, they pick up the phone and call me and say, I got a question about this.
Yeah. I think you've touched on a philosophy of approaching, and I'm in that same vein in the sense that the customer is it is about relationships. It's about serving, and you've got that servant's heart. And the chamber, you know, our motto, to serve and connect. Our desire is to make sure that we're serving well. You know, we're serving our customer well, and innate in that is that building of a relationship. And the other is just the byproduct of what good relationship and honest dealings are producing. So right. I love that.
Absolutely. I mean, and at the end of the day, that's what I would do. I'd rather have 100 relationships than 100 clients. And some of them may not be clients, but you know, I like it. You know, I provide the first hour of planning just to make sure that we're a good fit.
That's fair.
There's no charge for anybody coming into my office, sitting down here and talking. And sometimes I solve their problems while we're just sitting here in that hour, and there's no need to move forward.
So I do want to real quick, if somebody is listening and they're curious, you piqued their interest, they're thinking about their own retirement, and they're questioning whether or not they've got everything in the right place. So if they want to come and talk to you, let's tell the public, how do we do that? How do we get a hold of you? Can we come sit down and talk to you?
Couple of ways. First, you can call my office. I've got a great assistant that helps me keep my schedules intact. And if you call 828-559-0299, she'll be happy to get you on the schedule. Go to my web.
Yeah, go ahead.
Go to my website, www.retirerm.com. There's a couple resources that are there that are real helpful. There's some great books. For younger folks, it's the New Rules of Retirement Savings. Talks about how taxes impact and how you save for retirement. There's the No Compromise Retirement Plan, which is for folks 55 plus, that talks about getting things in the right place at the right time. This is the book that reshaped how I do planning. It's written by an actuary.
What's the name of the book again?
It's the No Compromise Retirement Plan.
Okay.
And then there's a third book that came out. I can't recall the title right off of the top of my head, but it's really talking about the impact that COVID has had on retirement planning. It just came out a couple of weeks ago. All three of them are there on my website, free. You have to sign up for my email distribution list just so I can make sure I get people that are actual people getting the book. But great resources that are there, articles that I've been in, publications that I've been in, all that stuff's on there. And there's a scheduling little button on there where you can schedule appointments right there online.
And it doesn't cost anything to schedule an appointment initially.
That's right.
Okay.
Yeah. And before anything, you know, I will let you know if there's going to be a cost involved in it, in the planning or not. But it needs to be a win-win. It needs to be something that's in my wheelhouse, something I do. I had a lady that attended one of my seminars down near Charlotte, and she was all about real estate and real estate investing. And I'm like, I'm not a realtor. I'm not an attorney. I don't do those types of things. I do believe in using real estate for retirement. I think it's a great thing, and I can calculate the income. How you do it is not in my wheelhouse.
Yeah, picking the right property, that's a whole different.
That's right. Just like stocks, I'm not good. I know people that do it better than I do it.
Yeah, and referrals are a great thing too. So.
Yeah.
Steve, I really appreciate you spending time with us and hearing about your story and how you got started and what's important to you. And I'm so glad that you are providing services to the residents and businesses of McDowell. You know, talking to small businesses, you can help them as well. It doesn't just have to be an individual looking at their own retirement. So please, everyone, reach out to Steve if you have any questions. Visit his website, the books. I'm going to go and check out a couple of those books. That COVID book sounds really interesting too, because that's definitely had an impact that we're all dealing with. So to be prepared and informed is probably the best way we can all move forward. So
absolutely.
All right. Thank you so much. It's been a pleasure.
Thank you, Tina. I always enjoy talking with you.
All right. You have a great one. Thanks again.
Thank you.
Bye-bye.